Watching CNBC Africa, we're first in business worldwide. Welcome to the show that will navigate a few shrewd investors to a path of wealth creation. This is Wealth Quest. I'm Samantha. Now, last week we started the 10 lessons with Stephen Silcock, a fund manager at Investec Wealth, whose grandfather bestowed lifelong 10 investment rules gathered from years of investing, and Stephen has been sharing with us. If you missed the first 5 lessons, you can go to www.abndigital.com for that past show of investment wisdom, where we looked at those first 5 rules. Still with us at the desk now as we unpack the second part of the rules, Rule 6 to Rule 10. We've got Stephen Silcock, fund manager at Investec Wealth, and Cobie, Legrange, strategist at ClucasGray Investment Managers, Roland, Rousseau, equity strategist from ABSA Capital. So Stephen, let's just run through, if anyone wasn't watching last week, who your grandfather was and why he was so important to South Africa's financial markets history.
Super, thanks very much, and good to be back again. My grandfather was both chairman and president of the JSC during some significant periods of boom and bust. A wonderful man and one of the doyens of the industry, a man who I was very fortunate enough to sit behind for 2 years, literally without making a trade, and just gather 60 years of investment advice from. He left 10 handwritten tips in a briefcase that I found. He's unfortunately passed on.
And he didn't even tell you about these. He's just kind of in a drawer somewhere on a briefcase. You found them.
Exactly right. And I wrote it as a note for my private clients at Investec Wealth. And it's just gathered an inordinate amount of interest, and it's a privilege to be able to share them today.
So there we go. We've talked about the first 5. Let's get into rule number 6. It reads, run profits and cut losses. One bad choice that is not eliminated quickly can negate a dozen good choices that improve moderately. So I suppose you give us your view, and then we'll get on to Cobie and Roland's view on that.
Great, yeah. I think this is fairly self-explanatory, and I think I mentioned it last week. A lot of these rules aren't necessarily groundbreaking, but they really appeal to the common sense of investors. So run profits and cut losses. Essentially, this is, as I said, fairly self-explanatory. Make sure that the shares that you are buying are continuing to go up. Look at good quality managers or companies with sound management that have a ring-fenced moat, if you will, around them, that will continue to stand the test of time with regards to their longevity.
Yeah, and Roland, we always talk about the importance of not just making returns, but ensuring that you don't lose money to start with. And I suppose that this kind of ties into that.
Yeah, I think our industry focuses far too much on trying to outperform. We can actually become incredibly wealthy by avoiding loss without having to outperform. So if you can just avoid some of the bad times, you will compound your wealth actually a lot quicker than constantly trying to outperform. And I think trying to cut your losses is one risk strategy that everyone should have in their portfolio.
The one issue that you have with building portfolios for clients is that it doesn't matter how much research you do, it doesn't matter how much you read. There are going to be mistakes that you're going to make, and that's just part and parcel of life. Something comes from left field, and it takes out a counter, and you should have maybe in hindsight have seen it coming, but quite frankly you can't have your eyes absolutely everywhere all the time. And I think this is what Alice is talking about here, is saying run profits and cut losses. If you know that the situation has changed and this counter's down by 10 or 15%, it's pointless waiting for it to be down 80% before you get rid of it in the portfolio. Rather sell it and go and look for other opportunities. But with that, I have to say something. If you look at your screen quickly now, you'll see the JSE over time. And here you see the JSE from 1970. And what I've done is I've actually taken a whole bunch of political events and some milestones globally and also here in South Africa. And I'm showing this to you relative to the JSE. If you've got a well-diversified portfolio and you're prepared to hold on for long periods of time, quite frankly, you're going to make money. Yep. So that's again got to do with that noise factor in the short term.
Yeah, and there's that point 9, I think, where they talk about diversity. But let's get into rule number 7. Remember the specific needs of your clients, elements such as life stage, financial commitments, and risk tolerance. It's not about your own portfolio; it's about what they need. Exactly. Of course, and what's life stage.
Yeah. I think this is a very key point, and I think a lot of the industry has lost a bit of this in literally just dropping products on clients. Relationships are and were to him the main tenet of his investment philosophy. And I think what he's saying is a person aged 40 has got a very different investment outlook and needs than a person who's 70, and you need to balance and rebalance the portfolio continually along with the needs of your client.
You know what's amazing here again for me is that to make this statement back in time must have been, I mean, the foresight that it takes in order to make this statement must have been unbelievable, because he's living in a situation where most people are stockbrokers. They're jockeying stock for clients. It's about product. We're about to move into that mutual fund or unit trust industry where people are just literally jockeying performance on a continuous basis. And what Alistair is saying here is, listen, forget about performance, forget about trying to be in the hottest stock, forget about any of that. What is it that the client needs? And it's amazing that all of us, that legislation has only really caught up in the last 5 years as to compares what he's saying now. You know, set an objective for your client, understand what your client requires, know your client. It's now legislated, but in the days that Alistair Martin was writing this, none of this was legislated.
Sure.
And I think at some places, I'm assuming it might not even have made him friends by saying something like this.
Right.
Yeah, but that's why we're saying these rules hold always, and as you say, there are changes in the regulatory environment that are going to affect asset managers. So let's move on to Rule 8. Never fall in love with a share or a sector. Many sectors have enjoyed their time in the sun, only to underperform in later cycles. What does that mean now?
Yeah, I think this is also key, and he used to use two analogies. The first one, funny enough, is a graph that hopefully we'll show you later, was Richemont. And he had a number of clients in Bloemfontein, and he always told the story of Anton Rupert wandering around to all the farmers in the Bloemfontein area and selling them shares in a company which is now Richemont, Remgro, and British American Tobacco. And for him to get those clients who had developed what he termed an emotional attachment to the shares was very hard. And over time, they've become very wealthy, not only through holding a smaller quantity of the share, but also through diversification.
And there we go, leading us on to point number 9. Keep a reasonable balance in your portfolio. A heavy weighting in one or more shares or sectors increases risk. Roland, take us through diversity, what it means today in the markets that we're faced with, and the kind of mood that, well, not mood, but momentum we're seeing in the markets.
Well, there are many ways to diversify, and one has to consider all of them. And I think we tend to just think of the more shares we throw in a portfolio, the better. But often you find that people still have biases towards certain sectors. So you need to look at sector level. You need to look at your diversification across countries nowadays. And probably the biggest impact on our portfolios at the moment has got nothing to do with the markets. It's got to do with the currency. So you might have to manage currency exposure as well in terms of risk.
Yeah,
sure.
Again, I mean, this is, again, and I come back to this, Alistair Martin is making a case here for holding a balanced set of assets. In the days when most people are stockbrokers and are saying, well, you know, quite frankly, if you own 50% of your portfolio on one counter and 20% in another counter, that's okay. He's saying, don't do that. Understand how each one of these counters are going to add up to a total portfolio where it holistically makes sense for your needs and holistically makes sense at the end of the day so that you don't blow up when there's a market correction or something happens. Okay. And he's talking about balanced fund management, what we call balanced fund management today. And he's making these comments, he's writing down these rules in times when this was not popular at all to do, you know. Again, lots of foresight, you know.
Yeah. And then once you've got your portfolio, don't fidget too much, he says. Don't chop and change. Many shares will reward holding out for the long term. Yeah. And I suppose, I don't know what's more important, but this one is a very important rule because churn is a big issue.
That's exactly right. And he certainly didn't believe in that. Once you've got the portfolio in the strategy, which is going to provide the clients with the best long-term outperformance, don't move it around too much. I think a great example is that graph that you showed earlier. I spoke at a school a little while ago that was celebrating a significant milestone, and we had had a relationship since 1965. I had a look at what the JSE was in 1965 in the speech. It was 146 points. It's now well over 43,000. I think that says it all.
Champagne corks popping and all that. Let's just round up the conversation. We talked about all the rules. Cobie, is there one that's more important than the others?
You know what? I think if I had to look, I think they're all important. So, I mean, it's very difficult to.
They're all interconnected, also.
Yeah, they all connected. I think for me at the end of the day, but I think the one that really stands out for me is rule number 7. Remember the specific needs of a client. Elements such as life stage, financial commitments, and risk tolerance. I think that becomes really, really important for me because. Without knowing your clients, then quite frankly, you can't do bespoke asset management. It's just not possible to do anything like that.
Roland, your favorite rule?
Short and sweet. I think returns are overrated and risk is where we have to really focus when it comes to managing wealth.
Well, there we go, short and sweet, and we still got some more time left. Stephen, you can round this off for us because, as you say, you learned from your grandfather. You were able to sit behind him, just watch him, and he's given us all of this investment wisdom, not just you. But if you had to take anything out of these rules, I mean, which is the most important?
Yeah. Just to sum up, Alice, thanks very much for the opportunity. I think for me, I would concur with Cobie. You have to know your client intimately. Always putting the client at the center of your investment decisions and not putting profits or returns before them. It's key for me.
So you didn't leave anything out? There's no rule number 11 that we
Well, he actually did have a rule number 11, which was quite controversial, and I actually left it off here. He said,
More to come.
never ever buy a gold share. It's a sector about which no reasonable judgment can be made. But we'll probably leave that for another show.
And as you know, as the gold bear on the show, I'll have to concur.
Well, I think it kind of ties into rule 8 where he starts talking about emotions here.
Yes.
And, that takes a lot of discipline, and perhaps certain type of people are suited to be in this profession and others not. So gold, Roland, are you looking at gold right now if we're going to just
gold
look
is
at
a
that
very short
specifically?
cycle, so it goes up and down a lot more quickly than other shares and other business cycles, and that's why it's very much more volatile and risky. And if you're going to have it, you got to understand risk very closely.
Yeah. But I mean, as you were saying, just getting back to valuations and stuff. I mean, you talked about all the kind of various aspects of it, but looking at that Richemont story there, being able to make so much money at its, and looking at where Richemont is right now relative to its PE, it tells a story about buying at certain levels of a stock. So Cobie, we didn't really go over that graph.
Well, I mean,
Perhaps
what you're seeing on screen at the moment is you're seeing obviously the price of Richemont through time, and you're seeing it from 1999. That's the blue line that you're seeing over there. And you can see how Richemont has just climbed the price. Hence, again, there are good reasons for not fidgeting with the portfolio. The red line that you're seeing there is obviously the valuation. That's the price to earnings ratio for this company, and that you're paying it over 20 times earnings for at the moment. But over time, you could quite frankly have accumulated this business at fairly decent valuations, as you can see down here.
Well, there we go. Certainly some fantastic insight when it comes to investing. That 10 of the best ideas from Alistair Martin and, of course, his grandson imparting that wisdom for us today. We've come to the end of this edition of WealthQuest. Remember, if you have any feedback for us, our email address is wealthquest@abn360.com. Find us on www.abndigital.com for our past shows and our blog. And stay tuned.